Navigating the world of taxation can feel like a daunting task when you first start a business in Australia. It is, however, a critical part of running a successful and compliant enterprise. Understanding your obligations from the very beginning helps you avoid penalties and manage your cash flow effectively. Think of tax not as a burden, but as a fundamental component of your business plan. It affects your pricing, your profits, and your legal standing. Getting it right ensures you contribute fairly to the public services we all rely on, while also keeping your business financially healthy and secure for the long term. This guide will help you understand the main types of taxes you will encounter. The Australian tax system is structured across three main levels: federal, state, and local. The federal government, through the Australian Taxation Office, collects the majority of taxes that apply to businesses nationwide. These include major taxes like the Goods and Services Tax, Company Income Tax, and Pay-as-you-go withholding for your employees. Each of these has specific rules about who needs to register, how much to pay, and when to report. Keeping track of these federal requirements is essential for every business, regardless of its size or industry, as they form the backbone of your compliance duties. On top of federal taxes, you also have responsibilities at the state or territory level. Each state and territory has its own revenue office and its own set of taxes. The most significant of these for many businesses is payroll tax, which applies once your total wages paid to employees exceed a certain threshold. Other state-based taxes include land tax on property you own and stamp duty on certain transactions, like buying a commercial vehicle or property. These taxes vary significantly between states, so it is vital to understand the specific rules for the location where your business operates. Finally, local government councils impose their own rates and fees. These are not typically called taxes, but they function in a similar way and are a mandatory cost of doing business. Local council rates are levied on the commercial property you own, or sometimes lease. Additionally, you may need to pay for various permits and licenses to operate legally, such as food safety permits for a cafe or outdoor dining licenses. These local charges are essential for funding community infrastructure and services, like waste collection and local road maintenance, which directly benefit your business operations. Staying on top of all three levels of tax is the key to smooth sailing. The Goods and Services Tax, commonly known as GST, is a broad-based tax of 10% on most goods, services, and other items sold or consumed in Australia. As a business owner, you must register for GST if your business has a current or projected annual turnover of $75,000 or more. For non-profit organisations, this threshold is higher, at $150,000. Once registered, you are required to collect GST from your customers by adding it to the price of your taxable sales. This collected GST is then paid to the Australian Taxation Office. It is a fundamental part of the pricing strategy for many Australian businesses. When you are registered for GST, you can also claim credits for the GST included in the price of goods and services you buy for your business. This is known as a GST credit. For example, if you purchase new office equipment or stock for your store, you can claim back the GST portion of that expense. The net effect is that you only pay GST on the final value you add. You report these amounts to the Australian Taxation Office by lodging a business activity statement, usually on a quarterly or monthly basis. The BAS calculates what you owe the ATO or what refund you might receive. Another crucial federal obligation is pay-as-you-go withholding. If you have employees, you are required to withhold tax from their salary or wages on their behalf. This system ensures that employees meet their annual income tax obligations gradually throughout the year, rather than facing a large bill at the end. The amount you need to withhold is determined by how much the employee earns and the information they provide in their tax file number declaration form. It is your responsibility as an employer to calculate this amount correctly, using the tax tables provided by the ATO. The money you withhold under the PAYG system does not belong to your business. You are simply holding it in trust for your employees before passing it on to the ATO. These withheld amounts are reported and paid to the ATO, typically at the same time you lodge your BAS. Failing to meet your PAYG withholding obligations can result in significant penalties. Alongside withholding tax, you must also make superannuation guarantee contributions for your eligible employees. This involves paying a percentage of their earnings into a nominated super fund to provide for their retirement. If your business is structured as a company, it is treated as a separate legal entity and must pay income tax on its profits. This is known as company tax. The company tax rate is set by the federal government and applies to the company's taxable income, which is its assessable income minus any allowable deductions. For the 2025 financial year, the full company tax rate is 30%. However, a lower rate of 25% applies to businesses that are considered a base rate entity, which generally means they have an aggregated turnover of less than $50 million and meet certain passive income tests. Companies usually pay their income tax through the pay-as-you-go installment system. This system breaks down your estimated annual income tax liability into smaller, regular payments. The ATO will typically notify you if you need to enter the PAYG installment system and will calculate your installment amount based on your most recently lodged tax return. These installments are then paid quarterly, helping you manage your company's tax bill throughout the year, instead of facing one large payment after lodging your annual company tax return. This helps with cash flow management and financial planning. In addition to income tax, businesses may also have to pay fringe benefits tax. FBT is a tax paid by employers on certain benefits they provide to their employees or their employees' associates, separate from their salary or wages. Common examples of fringe benefits include allowing an employee to use a work car for private purposes, paying for their gym membership, or providing them with entertainment like free tickets to a concert. FBT is a distinct tax from income tax and is calculated on the taxable value of the fringe benefits provided. The FBT year runs from the 1st of April to the 31st of March, which is different from the standard income tax year. If you provide fringe benefits, you must register for FBT with the ATO and lodge an annual FBT return. The FBT rate is currently set at 47%, which is equivalent to the top marginal income tax rate, to discourage employers from providing benefits as a way to avoid paying salary and wages that would be taxed at high rates. Understanding what constitutes a fringe benefit is important to ensure you are meeting all your tax obligations and avoiding unexpected liabilities. Beyond federal taxes, your business must comply with the specific tax laws of the state or territory in which it operates. The most common state-level tax affecting businesses with employees is payroll tax. This tax is levied on the total wages you pay to your employees once that amount exceeds a specific tax-free threshold. Both the tax rate and the threshold vary significantly between states and territories. For instance, one state might have a payroll tax threshold of $1 million, while another's might be lower or higher. It is essential to check the rules for your specific location. Another important state tax is land tax, which is an annual tax levied on the value of land you own, excluding your primary residence. If your business owns its premises, such as an office building, warehouse, or factory, you will likely be required to pay land tax on that property. Similar to payroll tax, the rates and thresholds for land tax are set by individual state and territory governments. Stamp duty is another transaction-based tax you might encounter. It applies to certain purchases, such as real estate, vehicles, and some business assets, and the amount payable depends on the value of the transaction. Some industries are also subject to specific federal taxes that are collected alongside state frameworks, like the luxury car tax and the wine equalization tax. LCT is a tax of 33% on cars with a GST inclusive value above a certain threshold, which affects businesses that sell or import luxury vehicles. WET is a 29% tax on the wholesale value of wine and is primarily relevant for wine producers, wholesalers, and importers. These specialized taxes show how important it is to understand the specific rules that apply to your particular industry and location. To stay compliant, the best approach is to be organized from day one. Register your business for all the necessary taxes as soon as you meet the requirements. Use the ATO's online services for business to manage your obligations. Lodge your BAS or installment activity statement on time, and keep accurate records of all your income and expenses. If you feel overwhelmed, consider seeking advice from a registered tax agent or accountant. They can help you navigate the complexities of the system, ensure you are claiming all the deductions you are entitled to, and keep your business on the right side of the law.